China's Evergrande saw its stock value drop 80% as it came back from a 17-month trading suspension on Monday.
Today, we delved into one of the most pressing issues dominating headlines globally: China's real estate crisis. A nation once synonymous with soaring skylines and ever-expanding construction has now been thrust into a tumultuous whirlwind of property market woes, shaking the very foundation of the world's second-largest economy. What led to this steep downfall? How will it impact China's trajectory? And what could it mean for the rest of the world? Stay tuned as we unravel the intricacies of this gripping saga. As we gaze upon the eerie side of abandoned shopping mall, desolated housing complexes, and stalled construction site, we're confronted with stark symbols of a crisis that has reshaped China's urban landscape. It's not just a tale of financial turbulence, it's a story of shattered dreams, broken promises, and complex interplay of economic policies, market forces, and human aspiration. In the early 2000s, China's property sectors experienced a seismic transformation, marked by an unprecedented construction frenzy that reshaped the nation's skyline and urban landscape. The privatization of real estate in the 1990s laid the groundwork for a dramatic surge in the property development as the once dilapidated and low-quality housing stock underwent a sweeping overhaul. Amidst this metamorphosis, China witnesses an exponential rise in urbanization, with millions flocking from rural areas to cities in pursuit of economic opportunities. This urban migration, coupled with a burgeoning middle class and a surging appetite for home ownership, fueled an insatiable demand for residential and commercial properties. The palpable optimism surrounding the property market was further bolstered by the prevailing beliefs that property prices were destined to perpetually ascend, creating an atmosphere ripe for investment and development. Skyscrapers dotted the horizon while sprawling apartments complex emerged as a symbol of China's economic might and development prowess. This period of economic exuberance was characterized by a buoyant sentiment that property ownership not only guaranteed a secure investment, but also symbolized social status and economic prosperity. The allure of property investment extended beyond domestic borders, attracting foreign investors keen on capitalizing on China's seemingly unstoppable economic trajectory. The property market, once a cornerstone of China's economic growth, became intertwined with the fabric of the nation's social and cultural identity. It served as a testament to the nation's meteoric rise as a global economic powerhouse, fostering a sense of pride and accomplishment amongst its citizens. However, beneath the veneer of unprecedented growth and prosperity lays the seed of the potential crisis. The unchecked exuberance in the property market, coupled with speculative investment practices and lax regulatory oversight, sets for a dangerous precipice that would soon send shockwaves through the nation's financial landscape, leaving behind a trail of shattered dreams and uncertain futures. Xi Jinping's ascension to the power in 2017 marked a critical juncture in China's approach to its burgeoning property market, emphasizing the social function of homes as places to live rather than mere vehicles of speculation. The leadership initiated a significant shift in regulatory focus, aiming to stabilize the volatile property sector and curtail excessive risk-taking. This ideological pivot gained momentum with an unveiling of the Three Red Lines policy in 2020, a pivotal moment in China's effort to rein in an unruly property market. The policy imposed stringent restriction on property developers' financing capabilities, including debt-to-cash ratio, debt-to-asset ratio, and net gearing ratio. This move, while lauded for its potential to mitigate financial risk, sent shockwaves through the industries accustomed to unrestrained expansion and investment. The regulatory overhaul sparked a wave of uncertainty and panic within the market, leading to a sharp downturn in investors' confidence and triggering a domino effect that reverberated through the broader financial ecosystem. The repercussions were felt not only domestically, but also across global financial markets, with investors and stakeholders closely monitoring the unfolding developments and their potential impact on international trade and investment. As industry giants like Evergrande and Country Garden grappled with the implication of a new regulatory landscape, the fragility of the sector became increasingly apparent. What initially seemed like a necessary corrective measure to rein in a runaway market eventually revealed the precarious balancing act that the Chinese government faced in navigating the fine line between economic stability and financial reform. The interplay between stringent regulations and market's insatiable demand for growth and profitability underscored the complexities of managing a sector that served as a linchpin of China's economic prosperity. Balancing the imperative to rein in excessive speculations and leverage with the need to maintain a stable economic trajectory emerged as a formidable challenge, one that would test the resilience of China's financial and regulatory apparatus in the face of unprecedented market volatility and global scrutiny. As China's property crisis deepened, the nation found itself grappling with a multifaceted turmoil characterized by a delicate interplay of social unrest and financial instability. The ramification of the crisis extended far beyond the realms of economic uncertainty, manifesting in a palpable atmosphere of unease and delusionment among the populace. The visible scars of the crisis were etched across the urban landscape, with stalled construction sites and incomplete property serving as tangible symbols of shattered dreams and unfulfilled promises. Homebuyers who had invested their life saving and taken a substantial mortgages found themselves embroiled in a state of limbo, uncertain about the fate of their investment and the security of their financial futures. Amidst this climate of uncertainty, a wave of public discontent and frustration swept across the nation, culminating the protests and demonstrations that underscored the gravity of the situation. The specter of social unrest loomed large, prompting concerns about the potential escalation of civil discontent and the impact of the nation's social fabric of political stability. In response to the growing unrest, the government intervened, orchestrating a series of measures aimed to alleviating the financial burden on households and ensuring the completion of stalled projects. The imperative to maintain social stability and restore consumers' confidence became paramount, necessitating a delicate balancing act between regulatory stringency and pragmatic intervention. The implications of this tumult were not confined within China's border, but reverberated through the corridors of the global finance and economics. The interconnectedness of the global economy underscored the significance of China's role as a key player of the global financial ecosystem, with the repercussion of the crisis transcending geopolitical boundaries and prompting a reassessment of international trade dynamics and diplomatic relations. As China grappled with the complex interplay of social unrest and financial instability, the nation embarked on a journey of introspection and recalibration, striving to reconcile the aspiration of its people with the imperatives of economic stability and sustainable growth. The path ahead remained fraught with challenges, yet the resilience and determination of Chinese populace and leadership served as a beacon of hope amidst the prevailing uncertainty, underscoring the nation's capacity to navigate the storm and emerge stronger on the other side. Amidst the comparison drawn between China's current prosperity crisis and the 2008 global financial meltdown, critical divergences emerge, highlighting the distinct features of China's financial ecosystem and its implication of the global economy. Unlike the complex and opaque financial instruments that precipitated the collapse of Wall Street giants in 2018, China's banking system operates with greater transparency and a more straightforward framework. Bolstered by robust government backing and extensive regulatory oversight, this divergence is further underscored by the fundamental difference in the nature of China's financial institution, which, despite facing mounting challenges, maintain a more resilient stance compared to the Western counterparts. The ample source of funding available to China banks, coupled with the government's unwavering support, offer a semblance of stability in the face of market volatility, lending a sense of cautious optimism amidst the prevailing uncertainty. Moreover, China's approach to managing the property crisis, characterized by swift government intervention and strategic policy adjustments, signifies a proactive stance in addressing systematic risk and maintaining economic stability. The measures implemented to alleviate the financial burden on households and support developers in completing stalled projects reflect a concerted effort to balance the imperative of financial prudence with the preservation of consumer confidence and social stability. While the potential of the financial crisis looms large, China's unique financial landscape presents a resilient front, offering a fighting chance to mitigate the far-reaching implications of a property market collapse. The intricate interplay between regulatory scrutiny, government intervention, and market dynamics served as a testament to the adaptability and resilience of China's financial system, underscoring its capacity to weather storms and emerge stronger in the face of adversity. As the global market grapples with the repercussion of China's property crisis, the divergence of the 2008 financial meltdown serves as a poignant reminder of the intricacies and idiosyncrasies inherent in the global financial ecosystem. It prompts a reassessment of the interconnectedness of the global economy and highlights the significance of a nuanced understanding of the diverse financial landscape in mitigating systemic risk and fostering sustainable economic growth. As the dust settles on China's tumultuous property market saga, the repercussion continues to echo through the corridors of global finance and economics. The crisis marked by regulatory shift, market turmoil, and unprecedented financial challenges serves as a stark reminder of the fragility inherent in even the most robust and economic system. While China's unique financial landscape offers a glimpse of the hopes amidst the turmoil, the far-reaching implication of the global economy and geopolitical dynamics demand a concerted and nuanced approach to navigating the aftermath of this unprecedented crisis. Subscribe to our channel for more insightful analysis and updates on global economic trends and geopolitical developments. Join us in the comment section below as we reflect on the complexities of China's property crisis and its implication for the global economic and geopolitical landscape. Share your insight and perspective on the potential pathway for recovery and the lessons learned from this watershed moment in global financial history.